Okay, hi everyone and welcome. I'm Asher from CryptoBooks and I'll be guiding you through this UK crypto tax webinar. Whether you're new to crypto or already active, this session will clarify how the HMRC treats crypto assets in 2025, what's changed, and what you need to do to stay compliant. Let's begin. So before we dive in, here's a quick look at what we'll be covering today. We'll start with an overview of the current framework for crypto taxation in the UK and the key updates introduced for the 2025 tax year. Next, we'll break down your tax obligations and reporting requirements, including what needs to be declared, when and how. Then we'll go through some case-by-case examples to make things more concrete, from simple buy and hold strategies to more complex DeFi and trade-in scenarios. Finally, we'll review the important deadlines you need to know, along with potential penalties for non-compliance or late filings. So CryptoBooks is the software behind this session. It tracks your crypto activity, calculates your gains and income, and generates UK tax reports. Everything we explain today follows HMRC rules and is designed to help you file correctly. Follow our channel for more guidance or create a free account to check your own tax situation. So to make sense of your obligations, we need to start from how the UK defines and classifies crypto for tax purposes. Here we'll break down the official framework and the 2025 updates so you can clearly see what's taxable, what isn't, and where unexpected obligations arise. The first thing to clarify is that despite the name, cryptocurrencies are not treated as currency under UK law. They're classified as property, just like a house, a car, or a piece of art. That's a crucial distinction because it changes the entire tax treatment. The FCA refers to them more broadly as crypto assets and breaks them down by function. Some act as payment tools, others resemble securities or give access to services. This classification matters when we look at how each use case might be taxed later on. So in the UK, HMRC is the authority in charge of enforcing tax policy on crypto. That means everything you do with crypto, from trade and staking, falls under their jurisdiction. And they don't just issue guidelines, they actively monitor, cross-check, and investigate. They can open an inquiry into your self-assessment tax return within 12 months of filing. That's the standard review window and it doesn't require any suspicion or wrongdoing. Sometimes it's random, sometimes it's based on risk indicators. But even beyond that 12-month window, HMRC can still act. If they later discover income or gains that weren't declared, they can issue what's called a discovery assessment that gives them an extended time to go back and claim unpaid tax. They're also equipped to investigate crypto specifically. HMRC has legal powers to request information directly from the exchanges, including platforms based outside the UK. And they use blockchain analytics to track wallet activity and compare it with what you've reported in your return. If there's a discrepancy, they don't just stop at your crypto accounts. They'll look at your bank statements, your spending habits, even your lifestyle, trying to match your declared income with how you actually live. So it's not only about rules, it's about understanding how HMRC enforces them and how much visibility they already have into crypto activity. One of the most significant developments in the UK's crypto landscape is the 2024 proposal for crypto taxation reform through what's known as the Property Bill. What makes this bill so important is that it formally introduces a third category of property, specifically for digital assets that includes cryptocurrencies, NFTs, and even carbon credits. If approved, this would mark the first time in British legal history that digital assets are explicitly recognised as personal property. This change has several concrete implications. First, it provides enhanced legal protection. Individuals and businesses will be better protected against fraud, scams, or theft involving digital assets, something that up until now has lived in a legal grey area. Second, it's a strategic move for the UK legal sector. By providing a clear framework, the bill is designed to attract companies working with digital assets to base their operations in the UK, making the legal environment more competitive and future-proof. More broadly, this signals that the UK is positioning itself as a legal front-runner in digital asset regulation, and this will have long-term effects on how crypto is treated in courts, in contracts, and ultimately in tax law. So after looking at the legal reform that aims to define crypto as personal property, let's now shift to the other major development, the Autumn Budget 2024. While the Property Bill focuses on legal status and protections, the budget delivers concrete tax changes that already affect how crypto gains and income are treated today. The Autumn Budget introduced several updates with a direct impact on crypto holders, especially those in higher tax brackets or with significant exposure. Let's walk through what's been confirmed so far. Let's start with capital gains. Since 30th of October 2024, the rates of crypto disposals have gone up. It's 18% if you're in the basic rate band or 24% if you're in the higher one. Before that date, the rates were 10% and 20%. It's a real increase in your tax burden, especially if you sold at a profit late in the year. Timing matters. Gains realised before 30th of October are taxed under the old system. Gains after follow the new one. And then secondly, inheritance tax. The threshold stays frozen at £325,000 until April 2030. That may not sound like a change, but it is. When thresholds stay flat and assets values rise, especially volatile ones like crypto, more estates end up crossing the line. So even if nothing seems to change, the tax exposure might quietly grow. Third, income tax. Thresholds remain frozen until 2028. For most crypto users, this means the basic rate applies up to £50,270. Whether your income's from staking, airdrops, or freelancing in the Web3 space, the frozen bans don't just affect salaried workers, they shape how crypto income is taxed too. And fourth, enforcement. 1.6 billion has been allocated to HMRC to tighten compliance. That includes 5,000 new officers, many of whom will be focused on sectors like crypto. The evidence that the government is clearly planning to make enforcement more visible and more effective. This is where tax and policy start aligning. Digital assets are no longer on the fringe, they're being pulled into the core of the UK's fiscal strategy. Now that we've covered the legal and policy framework, we can move into the practical side, your actual obligations. In this second part, we'll look at what needs to be reported, how different types of crypto activity are treated, and what HMRC expects from you in concrete terms. This is where theory becomes filing. Let's now get into the core question. What exactly are your tax obligations if you own or use crypto in the UK? At the most basic level, you're required to report your earnings through HMRC's self-assessment system. That includes two key forms. SA108 for capital gains. So if you've sold, swapped, or used crypto in a way that creates a disposal, that goes here. And SA100 for other types of income. This includes things like staking, rewards, airdrops, mining income, or anything earned through crypto that doesn't fall under capital gains. Whether you're paying capital gains tax or income tax depends on the nature of the activity, but in both cases, property reporting is mandatory. And crucially, reporting isn't just about paying, it's about having the right records in place, cost basis, dates, transactions values, and supporting evidence. Without that, you can't prove what you owe or what you don't. So in the UK, crypto holders are primarily subject to two taxes: capital gains tax and income tax. Let's start with capital gains tax, since it applies to a wide range of everyday crypto activities. Capital gains tax is triggered whenever there's a disposal of crypto. That means selling it in for fiat, swapping it for another token, or even using it to pay for goods or services. These are all taxable events. For the 2024-25 tax year, the annual capital gains tax allowance is £3,000. That's the amount of gains you can realise tax-free. Anything above that is taxed based on your income band. So here's how the rates work. Until 29th of October 2024, gains were taxed at 10% for basic rate taxpayers and 20% for higher rate tax ones. From 30th of October onwards, those rates increased to 18% and 24% respectively. So if you made a gain in November, for example, it's taxed under the new rates. The system is progressive. Your overall income determines how your gains are split across these bands. We'll walk through a practical example of this later on, but the key point here is that crypto gains are taxed just like gains from other types of property, and the rates have gone up. So calculating capital gains tax on your crypto gains isn't as straightforward as applying a flat rate. In the UK, what really matters is how your capital gains and your taxable income interact. That combination determines which capital gains tax rate applies. Let's walk through the steps. Step 1, applying the capital gains tax exemption. For the 2024-25 tax year, the annual allowance is £3,000. So if your total gains are £10,000, you only pay tax on the remaining £7,000. Step 2, determine how much of that £7,000 is taxed at 18% and how much at 24%. To do this, you need to add your taxable capital gains to your taxable income. Taxable income means your total income after subtracting the personal allowance of £12,570. Once you have that sum, taxable income plus taxable gains, compare it to the basic rate band threshold, which is £50,270 for the 2024-25 tax year. This threshold already includes the personal allowance. So HMRC does not give you extra room for capital gains just because part of your income wasn't taxed. Even if you paid no income tax on the first £12,570, that amount still uses up part of your basic rate band for capital gains tax purposes. And step 3, apply the rates accordingly. If the combined amount stays within £50,270, your capital gain tax are taxed at 18%. If it goes above that threshold, the portion of gains above the limit is taxed at 24%. In other words, capital gains tax is progressive. Only the part of your gains that pushes you over the threshold is taxed at the higher rate. But as we'll see in the next example, even a small change in income can shift how much of your gains fall into the higher band. This structure links your investment results directly to your income level, and that's why you can't calculate capital gains tax in isolation. So let's walk through a full example applying everything we've seen so far. Imagine your net personal income for the year is £40,000. You also realise a £20,000 capital gain from selling crypto. The first thing you do is apply the £3,000 capital gains tax allowance, which reduces your taxable gain to £17,000. Then we check how much room you have left in your basic rate band, which for 2024-25 goes up to £50,270. Since your income is £40,000, you still have £10,270 taxed at the basic capital gains tax rate of 18%. That gives you £10,270 times by 18%, which is £1,848 and 60p. The rest of the taxable gain, £6,730, is taxed at the higher capital gains tax rate of 24% because it pushes you above the basic band. That gives you £6,730 times 24%, which is £1,615 and 20 pence. So total capital gains tax to pay would be 1,848.60 plus 1,615.20, giving us a total of £3,463 and 80 pence. This is a clear example of how both capital gains tax rates can apply in the same year, depending on the interaction between your income and your gains. So coming from the example we just walked through, there's an important twist for the 2024-25 tax year. The increase in capital gains tax rates on 30th of October 2024. This change has created a split year where two different sets of rates apply, and it's causing real confusion. Before 30th of October, the rates were 10% for basic rate taxpayers and 20% for higher rate taxpayers. From 30th of October onwards, they jumped to 18% and 24%. That means any gain you realise before the change is taxed under the old rates, while gains after the 30th are taxed at the new ones. The issue that HMRC's own self-assessment software doesn't handle this correctly. When you fill in your SA100, the auto calculation still applies the old 10 to 20% rates across the board. It doesn't split your gains by date. To fix this, crypto taxpayers need to manually complete box 51 on the SA100 form. This is where you adjust the correct tax amount based on which part of your gains falls before or after the 30th of October. HMRC has published an official online calculator to help you work out this adjustment accurately. You simply input the relevant dates and amounts, and it tells you exactly what to report in box 51. You can find it on their website, and it's essential to use it if you traded or sold crypto after the rate exchange. So everything we've covered so far is focused on capital gains tax, how it works, when it applies, and how to calculate it correctly. But capital gains tax doesn't stand on its own. The amount you pay depends directly on your personal income, because capital gains tax rates are applied on top of your income level. So before you can work out how much you owe on your gains, you need to understand how income tax brackets work and how certain crypto activities can shift your position inside those bands. So let's clarify this. We've already said that when you dispose of crypto, for instance, selling, swapping, or spending, you generate capital gains. But as you know, not all crypto activity falls into that category. Some types of earnings like staking or mining rewards, airdrops, rewards from referral bonuses, or getting paid directly into crypto aren't counted as gains. Instead, they go into your personal income calculation. And that matters for two reasons. First, these activities count as personal income, and they must be included in your self-assessment. Once added, they're taxed together with your other income, according to the standard brackets for individuals. There's no separate rule. They simply raise your total income and sit alongside your salary, freelance earnings, or any other source. Second, this increase in income directly affects how your capital gains are taxed. Capital gains are layered on top of your income, and the rate you pay depends on how much of that total sits above the £50,270 threshold. So the more crypto income you earn, the more of your gains may fall into the higher capital gains tax rate band, even if your gains themselves haven't changed. So even modest crypto earnings, if not considered, can lead you to underestimate both your income tax and your capital gains tax. So at this point, we've already seen how crypto activity can fall under capital gains tax or income tax, depending on what you're doing. Now let's look at exactly where this gets reported in the self-assessment tax return, because knowing what to declare is only part of the job. You also need to know where to put it. If you've realized capital gains through disposals like sales, swaps, or spending, you'll report them in Form SA108, the capital gains summary. This is where you include acquisition costs, disposal proceeds, and apply the £3,000 exemption we discussed earlier. Then there's the income side. If you've earned crypto through staking, airdrops, referral programs, or mining, and it's not part of a business or regular trading activity, it goes into the SA100 under other income, usually in box 17. This is the same income we just talked about in the previous slide. It's classified as personal income and taxed according to the brackets we already saw. So here you're just assigning it to the correct section in the return. If instead you're trading regularly or operating a crypto-related business, then HMRC treats it as self-employment income. In that case, you'll declare it as such, with full business accounts like any freelance or commercial activity. And finally, if you've realised capital gains after the 30th of October 2024, don't forget the detail we covered earlier. The system doesn't apply the new capital gains tax rates automatically. You need to manually adjust your total using box 51. That's where the correct calculation goes, based on the HMRC adjustment calculator we mentioned. So now that you've understood what counts as a gain, what counts as income, and how crypto affects both, on top of that, I've just explained to you how it all translates into action, which form, which section, which box. So far we've talked about when capital gains arise, how they're taxed and where to report them. But what we haven't yet answered is the most technical part of the process. How do you actually calculate the gain? In other words, when you sell a token, which cost do you subtract from the proceeds to get your gain? That's where the UK applies a specific set of rules on how to assign a cost basis to each disposal. Not optional methods, but mandatory priorities. These rules are applied in a fixed order and should be checked for each individual sale. First, there's the same day rule. If you bought and sold the same asset on the same day, that transaction pair is matched first. You subtract the acquisition cost of that same day purchase to determine your gain or loss. Second, the 30-day rule. If you sell a crypto asset and then buy the same token again within 30 days, that later purchase is matched with the earlier sell, and it works both ways. This prevents people from quickly selling and rebuying to artificially reset their cost basis. And third, if neither of those applies, the disposal is matched against what HMRC calls the Section 104 pool. This is a running average of all your prior acquisitions of that asset. Each new purchase updates the pool by adjusting the average cost per unit. When you sell from the pool, you use that average to calculate your gain. So for every sale, HMRC has already decided which cost you're supposed to use. It's not up to you, and it's not based on the order in which you bought your assets. That's why it's essential that the software and calculation method applied follow these rules precisely. If the wrong cost basis is applied, the resulting tax calculation won't match HMRC's expectations. So let's walk through a practical example of how Section 104 pooling works. Let's say you bought one Ethereum in February 2022 for £1,000 and another one in July 22 for £1,800. Since these two purchases are not made of the same day or a 30-day matching rule, they're both added to your Section 104 pool. That pool now holds two Ethereum with a combined cost of £2,800, which gives you an average cost per token of £1,400. Now, suppose you sell one Ethereum in September 2025 for £2,500. You subtract your average cost of £1,400 from the sell proceeds to get a capital gain of £1,100. The other one ETH stays in the pool with the same cost basis of £1,400. When you sell it in the future, you'll use that same average to calculate any gain or loss. This method ensures that your gains are calculated fairly across multiple acquisitions, smoothing out price variations over time. So now let's see how the same day rule affects your capital gain calculations. On July 10th, you buy one Bitcoin in the morning for £20,000 and sell one Bitcoin in the afternoon for £25,000. Because both transactions happened on the same day, they are directly matched. This rule overrides the Section 104 pooling. You calculate the gain using the exact cost of the asset bought that same day. So here the gain is straightforward. £25,000 minus £20,000 equals £5,000. This gain is immediately taxable and doesn't enter the pool. If you have other Bitcoin in your Section 104 pool, they remain unaffected by this transaction. Now let's look at the 30-day rule, which applies when you sell crypto and then buy back the same asset within 30 days. So in this example, on August 1st, you sell two Ethereum for £3,000. Then on 20th of August, within 30 days, you rebuy two Ethereum for £2,600. Under HMRC rules, these two transactions are matched. This means you calculate the gain based on the exact pairing. £3,000 from the sale minus £2,600 from the repurchase equals a £400 capital gain. Like with the same day rule, this matched gain is excluded from the Section 104 pool. The pool only applies to unmatched transactions. So now that we've covered how the tax system works and how to calculate and report your crypto activity, we can move to the practical part, actual examples. In this section, we'll look at real scenarios, buy and hold, staking and DeFi activities, and breaking down how each one is treated from a tax perspective. This is where all the rules we've seen come together. Let's start with one of the most common situations, cashing out your crypto. Anytime you dispose of crypto, whether by selling it, trading it, or spending it, you trigger a potential capital gains tax event. And as we've seen, that means calculating a gain or loss based on the cost basis assigned through the rules we just covered. Here are the cases that count as a disposal. Selling crypto for fiat, like GBP or USD, this is the most straightforward type of disposal. Trading one crypto for another, including swaps with stablecoins, HMRC treats this as two transactions. You're selling the first asset and acquiring the second. Even if no cash changes hands, the gain is taxable. Spending crypto on goods or services, whether you're buying a laptop, paying a subscription, or even making a donation. If you use crypto for something, that's a disposal. And finally, gifting crypto. except when the gift is to a spouse and or civil partner. In all other cases, gifting is treated like a sale at market value, and you may have to pay capital gains tax even if you didn't receive anything in return. So even when you're not thinking about taxes, when you, for instance, send crypto to a friend or buy something online, HMRC sees those events as disposals and they expect them to be reported accordingly. After seeing what counts as a disposal, it's just as important to clarify what doesn't trigger any tax. And one of the most common misconceptions is about simply holding crypto. If you buy crypto and just hold it without selling, trading, spending, or earning income from it, you don't owe anything. There's no capital gains tax just for price appreciation. In the UK, holding is not a taxable event. This matters because many investors think that they need to report something just because their portfolio increased in value. But tax is only due when there's an action, a sale, a swap, a payment, or some kind of income. So as long as you're just holding, there's nothing to report and no tax to pay. So let's talk about airdrops and bounties, two ways people often receive crypto without making a direct purchase. If you receive a bounty in exchange for doing something, like testing a product, sharing a referral link, or writing a review, that's considered income. It must be declared as miscellaneous income in your self-assessment. With airdrops, HMRC makes an important distinction. If you receive tokens without providing any service or doing anything in return, and there's no connection to a business or trade, the airdrop isn't taxed as income. You don't pay anything at the time of receipt. But if the airdrop is part of a marketing campaign you contributed to, or it's linked to mining or another activity, it may count as income, just like a bounty. In both cases, if you later sell the tokens, any capital gain is subject to capital gains tax. The gain is calculated as the difference between what the tokens were worth when you received them and what they're worth when you sell them. And finally, if your crypto activity is considered a business or regular trade, then airdrops and bounties may be treated as trading income, not just miscellaneous. In that case, the rules for self-employment and full income tax reporting apply. So now let's move to another type of crypto activity, one that was much more common a few years ago, but that still raises tax questions for many users: crypto mining. You might not be running a massive mining rig from your garage anymore, but if you've received tokens through mining directly or via a pool, you need to understand how that's classified by HMRC. As with other crypto income, the first step is to determine the nature of the activity. HMRC doesn't apply a single rule here. Mining can be classified either as a hobby or as a business, and the difference is crucial for tax purposes. We've seen the same logic in earlier sides, but what matters is not just what you did, but how. This means the degree of activity, organization, risk, and commercial intent will define the tax rate. So let's break it down. If you're mining casually without structure or profit motive, maybe just experimenting or contributing to a network, then it's treated as a hobby. In that case, any crypto you receive must still be reported as miscellaneous income in the self-assessment. And just like with airdrops or staking, if you eventually dispose of those coins, capital gains tax will apply based on their market value increase since receipt. On the other hand, if your mining operation is systematic, profit-driven, and ongoing, HMRC treats it as a business. That means that income is subject to income tax under the self-employment regime. You may also owe national insurance contributions. Business-related expenses are deductible, and yes, proper record keeping becomes mandatory. Still, one thing doesn't change though. When you dispose of the mined assets, capital gains tax may apply if their value has increased. This framework mirrors what we've seen before. Just like staking rewards or airdrops, mining income can shift your tax position in multiple ways. The label hobby or business is what shapes the obligations, but either way, crypto received via mining is never tax-free. So now let's move to crypto staking, one of the most common crypto activities today. And as you can expect by now, it doesn't have a one-size-fits-all tax treatment. We've all seen how different crypto actions like mining or airdrops can fall under either income tax or capital gains tax, depending on the context. The same logic applies here. Staking rewards can be taxed as income or as capital gains. But what matters is how the activity is structured and what the economic substance is behind the transaction. Let's start with the income tax scenario. So if you're staking through a platform or protocol that pays returns periodically, has a known counterparty, or provides predictable rewards, then HMRC is likely to treat those staking rewards as personal income. This means they must be included in your self-assessment and taxed according to your income bracket, just like we saw earlier with mining income or referral bonuses. But there are also cases where staking rewards are not directly received as income. Let's say you receive tokens through staking and simply hold them, and then you later sell or exchange those tokens at a different price. In that case, the tax event arises at disposal and any gain is subject to capital gains tax. So same activity, different timing and context, different tax. Now here's the key update. In July 24, HMRC issued new guidance confirming that many DeFi activities, including staking and liquidity provision, may trigger a disposal even if you don't convert anything into fiat. So this applies particularly when you move tokens into or out of smart contracts or exchange them for derivatives. So if you're staking in DeFi, even just shifting assets into a protocol can create a capital gains tax event. That's a major change and it makes tracking your transactions more important than ever. So the bottom line is that staking can impact both your income tax and your capital gains tax. The difference generally depends on how and when the reward is realized and whether the platform setup counts as a transfer or a contract. So we've looked at how to report profits from crypto, but what happens if things go wrong? What if your tokens are lost? Say you can no longer access your wallet, or worse, even stolen? HMRC has a specific mechanism to deal with this situation. It's called a negligible value claim. And here's how it works. If you hold crypto that's become inaccessible, typically because the private keys are lost or the platform has collapsed, you can submit a claim to HMRC saying that those assets are now effectively worthless. But to do so, you still need to show that you own the asset. For example, it hasn't been disposed of. There is no realistic prospect of recovery. You're making the claim in good faith and with supporting evidence. If HMRC accepts the claim, they treat the asset as having been disposed of at a value close to zero and immediately reacquired at that same negligible value. This lets you crystallize a capital loss, which can then be used to offset gains from other disposals. The same approach applies to stolen crypto, as long as you can demonstrate that you had ownership and that the loss is permanent. So this is important because losses can only be claimed if they're recognized under tax law. Not all hacks or scams qualify, especially if recovery is still possible or if the ownership was legally transferred. So, if your crypto is gone and gone for good, a negligible value claim may help you recover at least part of the damage on your tax return. So we've seen how profits, income, and even losses are taxed, but what if you simply give or receive crypto as a gift? Let's break this down. So if you give crypto to someone who is not your spouse or civil partner, HMRC treats this as a disposal for capital gains purposes. You need to calculate a gain or a loss based on the market value of the crypto on the day of the gift. That value is treated as if you had sold the asset, even if no money changed hands. So if the gift is made to your spouse or civil partner, there's no immediate capital gains tax. The asset is transferred with its original base cost, so the recipient will carry over your acquisition value. Now, if you've been receiving crypto as a gift, you don't pay any tax when you receive it. But later, when you sell or exchange that crypto, capital gains tax will apply. The gain will be calculated based on the original base cost, either what the giver paid for it, if known, obviously, and the market value at the time of the gift. So to summarize, giving crypto may trigger capital gains tax unless it's to your spouse or civil partner. Receiving crypto is tax-free at first, but capital gains tax applies on disposal. And spousal gifts are exempt both at the time of the gift and in how the base cost is transferred, which is one of the clearest exceptions in UK crypto taxation. Now let's turn to NFTs. Same logic, but a few specific cases worth knowing. Just like with fungible tokens, if you sell, swap, or gift an NFT to someone other than your spouse or civil partner, that counts as a disposal. So capital gains tax applies. You need to calculate the gain or loss based on the acquisition cost and the market value of the time of disposal. Then we have other scenarios. Moving NFTs in and out of liquidity pools or smart contracts can also trigger capital gains tax because it may count as a change of beneficial ownership. And what about rewards? So if you earn NFTs from staking, yield farming, or play to earn games, HMRC treats those as income. That means income tax applies and the value of the reward must be declared as miscellaneous income on your self-assessment. Same goes for airdrops. If you receive an NFT without providing anything in return, it might seem tax-free, but if it's part of a broader activity or campaign, that's income too, taxed at market value when received. So let's now talk about forks. In blockchain terminology, a fork happens when the underlying code of a blockchain changes. This can result in two different outcomes, a soft fork or a hard fork. A soft fork is a backward compatible update, so no new coin is created. From a tax point of view, that means that there's no new asset entering your portfolio. No new income, no new disposal, so no tax implications at all. A hard fork instead creates a completely new token. For example, Bitcoin Cash was created from Bitcoin through a hard fork. If you held Bitcoin at the time, you may have received Bitcoin Cash. Now, even if this sounds like income, HMRC doesn't consider it taxable when received. You don't pay income tax just for getting coins from a hard fork. However, if you later sell or exchange those forked tokens, then capital gains tax comes into play. The gain will be calculated based on their market value at the time of disposal, and their acquisition cost is usually treated as zero unless HMRC guidance or case law evolves. So in short, no tax on receipt, but capital gains tax applies when you dispose. Now that we've covered how different types of crypto activities are taxed, it's time to talk about deadlines and what happens if you don't comply. In this final part, we'll go through the key tax filing dates for UK residents, the penalties for late submissions or payments, and how you can amend past returns if you realise you've made a mistake or missed something. Crypto taxation isn't just about calculating gains, it's also about knowing when and how to report them. This is where a lot of people slip up, even if they have the right figures. So the UK tax year starts on 6th of April and ends on the 5th of April of the following year. So for the 2024-25 fiscal year, we're talking about all crypto activity from 6th of April 24 to 5th of April 25. The first important date is 31st of October 2025. This is the deadline for submitting paper self-assessment forms. After that, you're required to file online. Then comes 30th of December 2025. If your total tax due across income and capital gains is under £3,000 and you file online by this date, HMRC can collect the amount via PAYE by adjusting your tax code. Finally, 31st of January 2026 is the critical deadline. It's when both the online filing and the payment must be completed. Missing this deadline triggers automatic penalties. Everything after 5th of April 2025 falls into the next reporting cycle, which will be due by 31st of January 2027. So in this section, we focus solely on breaches related to cryptocurrency taxation in the UK. We're not covering generic late filing or unrelated tax issues, but specific cases where a taxpayer with taxable crypto income or gains fails to declare or pay correctly. These fall into 5 categories: failure to notify, inaccuracy in a submitted return, late payment, criminal offences, and from 1st of January 2026, CARF non-compliance. In the next slides, we'll briefly go through each one. So the first case is where a taxpayer should have registered for self-assessment or filed the required forms for crypto income or gains, but didn't. HMRC charges a percentage penalty on the tax due, from 0% for an unprompted and genuine correction, up to 100% for the most serious and concealed cases. On top of that, daily interest is applied to the unpaid tax, currently around 6.5% per year. The second case is when you file your self-assessment but the return is wrong because crypto transactions are missing or amounts are understated. The penalty is again a percentage of the extra tax owed, with the same ranges as failure to notify, up to 30% for careless errors, up to 70% for deliberate behaviour, and up to 100% for deliberate and concealed behaviour. Interest is also charged from the original payment deadline. The third case is when the return is complete and correct, but the tax isn't paid by the deadline. Here HMRC applies daily interest, again around 6.5% per year, plus fixed penalties, 5% of the unpaid tax after 30 days, another 5% after 6 months, and a further 5% after 12 months. Those percentages are on whatever balance is still outstanding at each point. A time to pay arrangement can stop the percentage penalties, but interest keeps running until the balance is cleared. This final category applies only to the most serious and deliberate cases of crypto tax evasion, things like falsifying records or intentionally hiding assets. HMRC can take criminal action, which can mean unlimited fines and even prison sentences, on top of recovering the tax, interest, and civil penalties. These cases are pretty rare, but they are pursued where the evidence of fraud is clear. And here we are. So we've reached the end of the session, and now you've seen the full picture: how crypto is taxed in the UK, how to report your gains and income, what deadlines to respect, and what happens if you miss them. The rules are somehow clear, but the process can be messy. You need to track every trade, every token, and every gain, and then you need to get it right on your tax return. That's exactly what CryptoBooks is built for. It connects to your wallets and exchanges, calculates your capital gains, flags errors, and generates UK compliant tax reports. If you're dealing with crypto in any serious way, CryptoBooks will save you time, reduce your stress, and help you stay compliant. You can create a free account today and check where you stand. Ciao for now.